On October 3rd, 2019, Lebanese banks opened normally. By October 17th, they had quietly installed withdrawal limits nobody announced. By November, you couldn't get your own dollars out of your own account. The currency lost 90% of its value in 18 months. The people who saw it coming had already moved. Everyone else learned a new word, haircut. This is the playbook. It has run at least a dozen times in the last century. And it always starts the same way, with a week that looks almost fine. Here's the part nobody talks about. Currency collapses don't announce themselves. They arrive wearing the costume of a temporary liquidity problem. By the time the costume comes off, the exit doors are already locked. What I'm going to show you is the exact sequence, day by day, so that if you ever find yourself in week 1, you know what week 7 looks like. Here's the story. Governments always tell when the currency starts sliding. It's a temporary pressure, external factors, global headwinds. The central bank has tools. We are not Venezuela. We are not Zimbabwe. We have institutions. We have foreign reserves. The IMF is monitoring the situation. Everything is under control. And the population mostly believes it, not because they're naive, but because it has been true every other time. Most currency wobbles are just wobbles. The exchange rate dips, the central bank intervenes, it recovers. This happened in 1997 in South Korea. It happened in 1992 in the United Kingdom, Black Wednesday, when the pound was forced out of the European exchange rate mechanism in a single afternoon, despite the Bank of England spending billions to defend it. It happened dozens of times in emerging markets where the currency fell 20%, stabilized, and life continued. The problem is that a wobble and a collapse follow identical opening moves. The tell is not the size of the initial drop. The tell is what the government does on day 3. Now let's do the numbers that separate a wobble from a funeral. Foreign currency reserves are the key metric. A healthy economy typically holds 3 to 6 months of import cover in reserves, enough hard currency to keep buying oil, medicine, and food from abroad even if exports stall. When reserves fall below 2 months of cover, the IMF classifies the situation as critical. When they fall below 6 weeks, currency defense becomes mathematically impossible. Lebanon's reserves peaked at roughly $36 billion in 2017. By 2019, they were $30 billion, down 17%, but not alarming, except that $17 billion of that was borrowed from commercial banks and didn't actually belong to the central bank. Real usable reserves, about $13 billion. Import cover 4 months. Uncomfortable but not catastrophic. Then the Eurobond payments came due. $1.2 billion in March 2020. The government couldn't pay. Reserves fell to $11 billion, then $9 billion. Then the math became visible to anyone who was looking. Here's what that looks like in practice. Turkey 2021, the lira lost 44% of its value in a single year. Argentina has devalued its official currency by more than 50% in each of the last 3 years. Venezuela's inflation peaked at 1,000% in 2018, meaning a cup of coffee that cost 1 bolivar in January cost 10,000 bolivars by December. Not a typo, not a metaphor, 10,000. The number that should terrify you is not the inflation rate, it's the velocity. Slow inflation is manageable. Inflation that doubles every 4 weeks is a different category of problem. It's not an economic condition, it's a behavioral cascade, and behavioral cascades are what actually kill currencies. Let that sink in. Here's how the mechanism actually works. 7 days, same sequence every time. Day 1. The official exchange rate and the black market rate diverge by more than 10%. This is the signal. The government denies there is a black market. There is always a black market. Day 2. Banks quietly reduce dollar withdrawal limits. They do not announce this. You find out when you try to take money out. They call it liquidity management. It is the first door closing. Day 3. The government makes a statement. It is reassuring. It contains the phrase temporary measures. Every currency collapse in modern history has included a Day 3 statement containing the words temporary measures. Write that down. Day 4. Grocery stores start pricing in dollars, euros, or anything that isn't the local currency. This is the market telling you something the government won't. When a bakery starts quoting bread in a foreign currency, the local currency has functionally already died. The funeral just hasn't been scheduled yet. Day 5. Capital controls are formalized. Wire transfers freeze or require central bank approval. ATM limits drop to the equivalent of $20 a day. People line up. The lines are long. The mood is calm in a way that feels wrong. Day 6. A bank fails or is merged with a state entity over a weekend. The government describes it as a routine consolidation. It is not routine. Day 7. The official exchange rate is adjusted, by which they mean devalued, by which they mean the savings your parents held in local currency just lost 30% overnight while you were asleep. The finance minister appears on television looking very tired. This is not a hypothetical. This is Weimar Germany, 1923. This is Argentina, 2001. This is Zimbabwe, 2008. This is Lebanon, 2019. The costumes change. The script does not meet Elena. Elena is a middle-class pharmacist in a mid-sized city, in a country where inflation has been elevated but manageable for about 2 years. She has $40,000 in savings, half in local currency, half in a local bank account denominated in dollars. She's heard people talking about moving money abroad, but that sounds extreme. Her neighbor moved funds to a foreign bank last year, and it was complicated and expensive, and the currency didn't collapse, so it seemed like an overreaction. On day 1, Elena notices the exchange rate app on her phone shows a rate 12% worse than what her bank is offering. She assumes it's a glitch. On day 3, she reads the government statement and feels slightly reassured. On day 5, she goes to withdraw $500 to cover rent for her tenant who insists on dollars. The ATM gives her $200 and says the daily limit has been adjusted. She tries 3 different ATMs. On day 7, she discovers that her dollar-denominated account at the local bank was never actually held in dollars. The bank had converted her dollars into local currency and lent them out years ago. Her account balance, now converted back at the new official rate, is worth 40% less than it was on day 1. Elena did nothing wrong. She was not reckless. She was not uninformed. She was inside a system that had already decided how this would end before she knew the game had started. The only variable was whether you were inside the system or outside it when the clock ran out. So what do you actually do with this? Watch reserve coverage. Most central banks publish foreign reserve data monthly. If a country you're exposed to through travel, business, investment, or residency drops below 2 months of import cover, that is not background noise. That is a timer. Watch the spread. The gap between the official exchange rate and the informal rate is the market's real-time confidence indicator. A spread above 15% means institutional trust is already broken, even if the official narrative hasn't caught up. Watch capital flow restrictions. The moment a government makes it harder to move money out, it is signaling that it already knows people would move money out if they could. That asymmetry is information. Diversify across jurisdictions, not just asset classes. Having 3 different stock funds in the same country's banking system is not diversification. It is the same bet with different labels. A Swiss bank account, a brokerage in a different regulatory zone, physical gold. These are not paranoid. They are the equivalent of having a fire exit. You hope you never use it. And the hardest one, move early or not at all. The cost of moving money during a normal period, fees, taxes, complexity, is vastly lower than the cost of moving money during a crisis. When transfer limits are $200 a day and the conversion rate has been set by a very nervous finance minister at 3 a.m., here's the uncomfortable math, and I'll say it without softening it. The people who come out of currency, collapses intact, are not smarter than everyone else. They are not more connected. They are not insiders. They simply acted on information that was publicly available 2 to 3 years before the collapse, at a moment when acting felt unnecessary and slightly embarrassing. The people who lose everything waited for certainty, and certainty, in a currency crisis, arrives on day 7. After the doors are closed, there have been 14 significant currency collapses since 1990. In every single case, the warning indicators were visible 12 to 24 months before the terminal event. In every single case, the majority of ordinary savers either didn't see the indicators or saw them and decided the situation wasn't serious enough to act. In every single case, they were right until the day they weren't. The pattern isn't a secret. The pattern is just boring until it isn't. So I want to hear where you land. A. This is a problem for other countries. Developed economies have institutional safeguards that make this impossible. B. The warning signs are real, but acting on them without certainty feels like overreacting. C. The asymmetry is obvious. The cost of being early is inconvenience. The cost of being late is everything. Drop your answer. And if you've never once looked up your country's foreign reserve coverage number, that's worth a minute of your time before you go to bed tonight.